So today I am going to go through everything that you need to know about accounting in 10 minutes. Just to give you a bit of background, I studied as an accountant. If you factor in university, I've probably been doing accounting for 10 years. I think it's a really good career to go into. Just to say this as well about accounting, I still think it's a very good base in terms of getting an understanding of how a business operates. That's the reason I got into accounting. I wanted to know the financial information behind why companies operate. If you look at the FTSE 100 companies, 40% of CEOs have a professional qualification and 20% of them have an accountancy qualification. So it's still a relevant thing, it's still an important thing to get into. So without making this intro any longer, I'll set 10 minutes on the clock and go through everything you need to know about accounting. So firstly, I just want to go through why we actually do accounting and why does it exist. So it's principally a form of record keeping. So we need to keep track of how the company is performing. This is an indication of how we are operating our business. We get a better understanding how our business is performing as business owners if we know what is actually happening from a financial perspective within our business. So another reason is to inform investors and to show investors and stakeholders how you're performing. So businesses are generally set up to provide wealth to their shareholders. So if I was to set up a business as a sole trader or to just own my own limited company, I would want to create a value in order to pay me for the money that I've put into this business. I put £10,000 in. I want to know what kind of return I'm going to get. So as an investor, that's what investors do. They buy shares within businesses and these businesses give back return to their investors. So it's all about creating value for your investors. And another indicator is, say you have stakeholders within your business. So these are the people like employees. Say there's a bank and they need to know whether you're financially secure enough in order to give you a loan. They need to see your financial statements as an indicator of how you're performing. So it's all about providing transparency and information to your investors and to different stakeholders. That's why we do accounting. It's to keep track, to record keep, and also to show performance. So to start, the accounting profession, you could probably split down into 3 different areas. This is what the 3 areas that people think about. The corporate area, so this is the preparation of corporate accounts. Also there's financial planning, budgeting, analysis within different companies. There's the high street, so this is preparing small business accounts, preparing tax returns, self-assessment returns. And then there's tax accounting, which is probably what most people think of when they think of accountants. They think they're just trying to reduce your tax liability. Because mainly when you learn about accounting, you learn about the preparation of accounts. So that's going to be what the main focus will be, and then I'll touch on some of the things that high street accountants actually involve. Firstly, in order to become an accountant as well, you need to have a qualification. The 4 qualifications that I generally think of are the ACA, the ACCA, the CIMA, and the CIPFA. So the difference between these are, the ACA is the professional qualification. This is what you generally do with a professional firm. Whilst you're doing something like auditing or management consulting, you will have to have a sponsorship from a company in order to actually study the ACA, and you have to do 3 years work experience. The ACCA is another qualification which is good. I think you can pay for this yourself, and it focuses on business issues. CIMA is for accounting for businesses as well, and CIPFA is a professional accountancy qualification specifically to public services. So in order to understand accounting, you have to understand the 3 main statements that are prepared as part of company accounts. So this is the profit or loss account, the balance sheet, and the cash flow statement. So the profit or loss account will show the performance of a company in any given year, in their financial year. So what that means is if you look at their revenue and costs within their financial year, you can arrive at what their profit after tax is, and therefore get an indication of how the company performed in that year. And then you can look at the last 5 years and see each profit or loss account and see how the revenue has grown, see how the costs have increased or decreased, and you can see the financial performance of that company. The balance sheet, so the balance sheet shows the statement of financial position. This will show you the assets, liabilities, and equity in a company at any given point. So this is not the performance of a company over the year, but it will show you the accumulative effect of the performance since the time that it registered itself as a company. This is a great indicator to see if the company is close to being within liquidation or if it's near solvency. What that means is you can see what their liability position is within the balance sheet and see if it's higher than their asset position. If more money has to be paid out than they're actually going to receive, then you know that the company isn't in a very good position. Also, your debt is held on your balance sheet, so you can see how easily it is for that company to be able to service their debt. Just like it is for an individual, when you have a lot of debt, say you have car financing, if you're not making enough money through your income to pay off that debt, you will be in a poor financial position. And the same thing can be seen on the balance sheet within a company where everything has to be held on the balance sheet. The last statement is the cash flow statement. So this will show you how much cash has been spent and received in any given year. So now I'll break down each of the statements in a bit more detail to give you an understanding of how they're broken down. So the profit or loss account. So this is split down into sales or revenue, or sometimes called turnover. So if you're selling a product, this will be how many units you've sold multiplied by the price of those units. So that's the first line, is revenue. Cost of sales is the second line. So cost of sales is effectively the direct costs attributable to making the sale. This would be the manufacturing costs or the materials or the direct labor that has gone into actually making and selling the items that you have generated. If you take the net position between sales and cost of sales, you arrive at your gross profit. So your gross profit, now people sometimes ask what the gross margin is. That's effectively your gross profit divided by your sales. So if you sold £100 worth of goods, your costs attributable to those goods were £70 and you made £30 gross profit, your gross margin would effectively be 30%. So after gross profit, you have overheads and expenses. So these are more indirect costs attributable to servicing your company. So that will be, say, rent, electricity, indirect costs like financing costs, legal fees, these general things that are indirect to actually the main operations of your business and actually selling the goods that you're trying to sell to customers. Another cost that can go into here is depreciation. So when you buy an asset like a piece of machinery that is making the things that you're going to sell, that has a serviceable life. So that could be, say, 5 years. So what that would mean is, just like when you buy a car, for instance, as an individual, that car will only last you 5, 10, 15 years. You have to take the value of that car divided by the number of years, and this will provide you with a depreciation figure. This has to get charged to your profit or loss account. Once you've taken off these overhead expenses, you arrive at an operating profit. Then when you reduce your interest charges from this will be the interest that is charged in that period of time on the loans that you have in order to run your business. Once you've shown those charges, then that arrives at your net profit. Then you take off your taxation. The tax charge is dictated by your taxable income. Your taxable income is slightly different to your net profit because there are certain charges that are non-taxable. So these are things like depreciation. So if you have your net profit, you have to add back your depreciation in order to arrive at what your taxable income is. Then you use that taxable income multiplied by whatever the tax rate is within your country in order to arrive at your taxation. That will get you to profit after tax. And that is pretty much a summary of what the profit or loss account shows. And that will only show you the activity within 1 year. There are instances where a company can have a longer financial year, because when you start your business, you can actually dictate when the company's end date is. So you can have an extended period. It's generally 1 year. It will be 1 year 90% of the time. So that is your profit or loss account. So your balance sheet shows you what your current assets are. This gets split down into current assets and non-current assets. So your current assets, these are assets that have a life of less than 1 year. So if you're selling a product to somebody, then they owe you money for that product, provided they haven't already given it to you in cash. So that money, that accounts receivable amount that the person that owes you, they will pay you that within 1 year. So this will be a current asset. So that gets shown within your current assets. Your non-current assets or your long-term assets are things like property and equipment. Say you buy a car and it's capitalized within your business and it's going to last longer than 5 years, you will show this as a non-current asset. Then you'll have liabilities. So this is money that is owed to other people. So likewise, when someone owes you money, you will show that as an asset or current asset. You will also owe other people money for, say, buying the inventory that you needed or buying the stock that you needed in order to sell on to somebody else. So the money you owe somebody else, you will then have to show on your balance sheet as accounts payable. Then you'll have things like long-term debt that gets shown within your non-current liabilities. And then finally, you have equity. So equity is the share capital that's within your company. So when you first start your business, you will have shareholders or people who own that company. Say I put £30 into a business and two other people put £30 into a business and someone else put £10 into a business, then effectively we've put £100 into that business. I will own 30% of it because I initially put £30 share capital into that business. And then you have retained earnings. So if you take your profit after tax that we went over in the profit or loss statement, and we look at every profit or loss account up to this current date, these all get accumulated within your retained earnings. In order to pay out dividends, you have to have a positive retained earnings position. So if you ever pay out dividends to your shareholders, so as me being a shareholder with a 30% stake in this business, if I was to pay dividends to the shareholders, I would have to pay 30% of that dividend or money out to your investors. 30% would come to me because I own 30% in that company. So the last statement that you really need to get a grasp on is the cash flow statement. Now, the cash flow statement shows simply what cash has come in and out of a business in any given year. So like the profit or loss account, that shows the financial performance of a company within that year. The cash flow statement will show you how much cash has come in and out of the business, how much cash is being generated. So the way that this gets split down is cash from operations. So this is the day-to-day running of the business, how much cash is being generated. Then there's cash from investing activities. So this is from buying property, plant and equipment. This is from investing in your company, using the cash that's built up over the years to reinvest and to buy more equipment to grow your business. Then there's financing activities. So this could be if you have a loan from a bank, or if you have an increase in amount of shareholders will put money into the business. That all gets shown within your cash from financing activities. And then at the bottom of the cash flow statement, it will show how much your cash has increased year on year. Now, there's a massive interplay between all these financial statements. Primarily though, when you post a transaction, these transactions are posted between the profit or loss account and the balance sheet, or you have a transaction that's posted between different areas within the balance sheet. The cash flow statement is normally recorded as a separate device after reviewing what's happened within the transactions of your business. So for instance, if I sell something to somebody for £100, they may owe me £100, but I have yet to receive that cash. So cash is a byproduct of the transaction that's occurring between the profit and loss account and the balance sheet. So here are a few examples. The profit and loss. So when you generate revenue, this gets recorded within your revenue section of your profit and loss account. So your revenue increases. When your revenue increases, your asset position increases on your balance sheet because someone owes you money or they've given you cash, and cash and people owing you money goes into the asset section of your balance sheet. Once you've received the cash for the money owing to you and the transaction's complete, you will show the cash coming in within your operating activities of your cash flow statement. So that's the interplay between the three accounts. So the other interplay is between the balance sheet and the balance sheet. So the way this can happen is someone could owe you money. So effectively you have a receivable on your balance sheet as an asset. Then when they pay you money, you would have to reduce this receivable position because they don't owe you that money anymore, and increase your cash position. So effectively you are reducing your asset position and then increasing your asset position within different lines in your balance sheet. So at that moment where the cash is received for the money owed, that's when it gets recorded within your cash flow statement. So there's always an interplay between these three types of accounts. You have the interplay between your profit and loss account and your balance sheet. When something happens within the year, that has to get recorded as a transaction. So that's revenue, expenses, these kind of things go on your profit or loss account, and you have to show the other side of the transaction in your balance sheet. You will have different transactions moving between your balance sheet and other lines in your balance sheet. So for instance, if you're paying down your debt, you will have to take money out of your cash within your balance sheet and pay down debt on your liabilities section of your balance sheet. And then all of these, when there's a cash implication, it all has to get recorded within your cash flow statement within that year. So in order to record any of these transactions that I previously discussed, you have to use something that people refer to as double entry or bookkeeping. So when you post a transaction, you will always post it between your profit or loss account and your balance sheet, or your balance sheet and your balance sheet. But every time you post a transaction, you will have two sides to that posting. So that's why it's called double entry. So if I was to generate revenue, then one side of that transaction would be the revenue on my profit or loss account, and the other side of the transaction will be increasing my receivable position, or the cash I've received for the item that I've sold. So your asset position increases. So there's always an equal and opposite transaction occurring between your profit or loss and balance sheet. That's why if you take your balance sheet and take your assets, liabilities, and equity, it should net down to zero. So a transaction is broken down into debits and credits. These are what are referred to in accountancy terms. So basically, a debit will increase your asset position on your balance sheet and will also increase your expense position on your profit or loss account. Whereas a credit will increase your liability position on your balance sheet and increase your revenue position on your profit or loss account. As an example of different types of transactions, when you make a sale, you will increase your revenue, but you'll also increase your receivable position on your balance sheet. So to increase your revenue, you will credit your revenue account. So you increase the revenue of your profit or loss account, but you'll also have to increase the asset position using a debit, because a debit increases the asset position on your balance sheet. So there's two sides. So to every transaction, there'll be a debit and a credit. So in that case, you credit revenue, debit your receivable position. Now, as an expense, the opposite is true. So to increase your expense position on your profit or loss account, you will debit your profit or loss, and to increase your liability position, because you owe someone money for the thing that you've expensed on your profit or loss account, you will have to credit your balance sheet. So when you receive money for the amount owed to you, so you've made that sale, they owe you money, so you've increased your asset position, your accounts receivable position, but now they've paid you for the amount owing to you. So in order to reduce your asset position, you have to credit your balance sheet. So to credit your balance sheet, you credit your receivable account, which is where you're holding the amount of money owed to you, but you've received cash for the amount owed. So you have to increase your cash position. So you debit your cash account. So that's where the interplay between balance sheet and balance sheet happens. When you make a sale, the interplay is between your profit or loss account and your balance sheet. But once you've received money for a transaction that's already occurred in the past, well, now there's an interplay between one balance sheet account and another balance sheet account. So the same is true for when you owe someone money. So like when you have an expense, as we've discussed, this generates a liability position on your balance sheet. So in order to, when you need to actually pay this person for the item that you purchased, maybe a month later on, you have a month of worth of credit, you have to reduce your liability position or accounts payable position. You do this by debiting your liability position, and you have to reduce your cash position. So to reduce your asset, you have to credit your balance sheet. So this takes a little bit of getting your head around, but there's also one other section of your balance sheet, if you remember, and that is the equity section of your balance sheet. So if you were to reduce your retained earnings, or you were to pay a dividend out of your retained earnings, so the money you've earned within this company, to reduce your equity position, you would debit your equity. Then you need the cash in order to pay those dividends. Cash sits in assets within your balance sheet, so to reduce your asset position, you have to credit your asset position, so credit cash. So there's always two sides to both those situations. There's always a debit and there's always a credit. So to go over to something a bit more complicated is accruals and prepayments, which are two balances on your balance sheet that people get a little bit more confused with. So when you're preparing a set of accounts, you prepare it on an accruals principle. The accruals principle is the concept that you should record accounting transactions in the period in which they actually occur, rather than the period in which the cash flows related to them occur. So what that means is I could pay for insurance in the third year of having my accounts, but I still have incurred a charge every month. I'm just accruing that charge over the year in which I hold the insurance. Now, an accrual doesn't always have to be a charge. You can have accrued income. So that means if you are providing a service to someone that is going over a year span, so if I'm providing insurance to somebody else, well, I need to accrue the income for that, even though I have yet to be paid for that amount. And this is principally why I say that the profit or loss account and the balance sheet work independently of the cash flow statement, because you could generate revenue or you could generate an expense, but it's yet to happen. It's a bit like you work in a company that pays you every month, but you might work 2 weeks of that month. Well, if you were to prepare your own profit or loss for you personally, well, you have worked 2 weeks, so you are due 2 weeks worth of earnings. So if you were to say that that was your revenue, then you would prepare your profit or loss account by saying that you have 2 weeks worth of earnings, although they have not paid you yet. That's the accrual principle, is that you have to accrue income and expenses over the period in which they're due. So another concept is prepayments. So a prepayment is effectively a scenario where you've paid for a service that has yet to occur. And because you've paid for it, you are due that service. So therefore it's an asset. Now, the prepayment is a situation where you've paid for a service in advance and have yet to get it. So you have that asset there because you're due that service. So when you accrue an expense for a service, you're basically saying that you have an expense that you're yet to pay money for. So you still have to recognize that as incurring within the year that you've prepared your accounts. And as a result, you have to increase your liability position within the account that's called accrual. So on your balance sheet, you will see an accrued amount. So that's amount of monies. So these are things that you've incurred charges for but yet to pay. When you pay for a service in advance that is yet to occur, you will increase your asset position under the line prepayments. And because I've already paid for it in advance, I would reduce my cash position. So I debit prepayments and credit cash. Then when the service has occurred, I would then have to recognize the expense because I've paid for, say, some service work to be performed at my factory. I have paid them in advance, they've finally gone and done it. Well, okay, that service has occurred within this financial year. I now have to record that within my profit or loss statement. So I would debit my profit or loss account to recognize an expense within my profit or loss, and I would credit my prepayment because I already have an account set up for that service that has occurred. So I'd credit my asset position, I'd reduce that asset. I've now had the service that was due to me. So those are two a little bit more complicated concepts. Hopefully I've gone over those okay. So once you've compiled all these transactions, you will put together what's called a trial balance. So that is basically a list of all the transactions that have occurred in the year. Once you've put all of these together, you can then prepare these 3 statements that we've just gone over: the balance sheet, the profit or loss account, and the cash flow statement. Now, when you're preparing these statements, say you've gone over and you've prepared all 3 of the statements as we've previously discussed, well, you would have certain balances that you need to have a bit more detail on in order to give investors a clearer image of what's happening. It might be all well and good to say that you've incurred 100 million of expenses, but what's making up those expenses? Or you have 10 million of property and plant and equipment. Well, I need to see a breakdown of each of these. So this gets shown within the notes section of your financial statements. So this is below all 3 of those statements. You then have a more detailed view of what's happened. So you can use the transactions in order to build up these views. So an example of one of these notes is the property, plant and equipment note within your financial statements. So this will split down using land, buildings, machinery, cars, furniture, fixtures, construction in progress. These are all the different assets within property, plant and equipment. This gets broken down so you can see how much you've purchased in the year, how much you've disposed of, what your depreciation position is, and all the other notes are very similar to this. Basically, maybe not in the same format, but you have to show a certain amount of detail so people get a more granular view of how your business is operating. So that is pretty much the full view of what people are preparing in order to see a set of accounts. You have the 3 statements, you have notes, you've pulled together all these transactions. There are a lot more transactions, obviously, but the core is this: everything has a double entry. Every posting, every transaction that you make, every time you incur an expense, you have to record it and put it within any one of those financial statements. So if you understand these 3 financial statements, you effectively understand accounting. Now, just to give a bit more detail, there are 2 different ways that accounts can be prepared. You can prepare them under UK GAAP, and you can prepare them under IFRS. So the major difference between GAAP and IFRS is that GAAP is rule-based, whereas IFRS is principle-based. Another difference is IFRS and GAAP is the methodology used to assess an accounting treatment. Under GAAP, the research is more focused on literature, whereas under IFRS, the review of the facts pattern is more thorough. The convergence of accounting standards refers to the goal of establishing a single set of accounting standards that will be used internationally to reduce the difference between US GAAP and IFRS. So basically, UK GAAP is generally accepted accounting practices. A lot of financial statements are prepared under these. It's a more simplistic way of preparing a set of accounts, and it's a lot shorter, and you can prepare a set of accounts in an abbreviated fashion, and that's the way that small business accounts are prepared under. IFRS is a more global view, and that's a way of trying to give greater transparency, because you effectively have your accounts split. You effectively can compare your accounts to any account in the world because it's all prepared under a single accounting methodology. Now, I've gone over more what corporate accounting is about, or if you were to study accounting, you have to study the transactions, you have to study how to prepare these kind of accounts, what each account is based on. So I went over very quickly what's included within the profit or loss, balance sheet, cash flow statement, but each of these goes down into much granular level of detail. You have to understand exactly why you post things within these accounts. Now, there are things that people generally think of now when you think of accounting, and that's small business accounting. So if you just own a small business, and still the principles are true, but there's probably a greater focus on tax. So the type of things people think about within small business accounting is you prepare an abbreviated account. And what I mean by abbreviated, I mean you don't have to show a cash flow statement, for instance. You might just have to show your profit and loss account, an abbreviated version of your balance sheet, and then only some notes, basically. Another thing that small business accounting focuses on is tax planning. So that's how do you optimize your accounting treatment, and how do you prepare yourself in a position where you're able to reduce how much tax you have to pay to HMRC every year. Another thing that small business accountants do is prepare corporation tax for companies. They also look at you as an individual and prepare self-assessment tax returns for you personally. This shows how much income tax that you've paid yourself. They'll have to file your company accounts to Companies House. They'll have to submit your corporation tax to HMRC. So the government has a record of how your business is operating every year. So that's basically it. I think that might be over 10 minutes. But that is an overview of accounting. Clearly that is not everything, and as I discuss it I realize how much more in depth you can go, but that is a basis of what you do within accounting, the accounting profession, and certain transactions, and what's at the core of accounting, which is the financial statements, and trying to get transparency and information through reviewing those accounting statements. I'll make more videos of this if people actually see it and like it, so it's something that uses my qualification. If you want to know more about any of this kind of stuff, then let me know. Thank you.